So if you've already taken that big step and secured life insurance, you're probably thinking of it as, a financial foundation for your family.
It is. It's the bedrock for sure.
But for most of us, that policy feels kind of static. You pick a number, you pay the premium, and that's it. Conversation over.
Right. But what our source material really shows is that the ability to truly customize that policy to make it future-proof, that lies in the extras.
Exactly.
Yeah.
And that's our mission for this deep dive, to get into those tools, the riders, and the supplementary benefits.
And we should probably start with the core difference between those two, because people use the terms interchangeably, but they are not the same thing.
A really important distinction.
It all comes down to timing. So riders, they provide extra benefits that are paid out after death. They boost the death benefit.
Okay. And supplementary benefit.
Those provide benefits before death. Think a disability waiver that keeps your policy going if you can't work.
Got it. So for this dive, we're focusing just on the death benefit riders, the tools that let you really tailor a standard policy.
And we should mention, almost all of these riders cost extra. And with one very big exception, they don't increase your policy's cash surrender value or CSV.
And that exception is where we should start because it is, well, it's a real game changer.
Okay, let's jump in. We're talking about the paid-up additions rider, the PUA rider.
And you called it the rule breaker. Why?
Because it's really the only common rider that actively increases both the death benefit and the cash surrender value at the same time.
So how does that work? How is that different from just, overfunding the base policy?
Well, it's available for permanent policies like whole life or universal life, and the rider lets you put in these lump sum payments.
Like for cash.
Exactly. And that cash is used to buy tiny, fully paid up mini policies of permanent insurance.
So you're not just paying down one policy, you're stacking a bunch of little ones on top of it.
That's a great way to think of it. A growing stack of mini policies. And because they're paid up instantly, they start earning their own cash value and dividends right away.
Okay, but the real aha moment here, the key insight, has to be about why it built cash value so much faster. I'm guessing it has to do with fees.
You're right on it. With your base policy, a huge chunk of your early premiums gets eaten up by commissions, admin costs, the policy loading,
The overhead.
the overhead.
Yeah.
But PUA premiums, they bypass most of that. They're buying insurance at what's called the net premium rate. The infrastructure's already there, so more of your dollar goes straight to work building that cash value.
So it's like dollar cost averaging into super efficient insurance. And the real future-proofing part of this is the underwriting.
Absolutely. The rider is underwritten just once, right at the start with the main policy. That means you are locked in. You can buy these additions for years, even if your health completely tanks.
Let's use the example of Valerie. She's a 35-year-old professional. She gets a $500,000 whole life policy, and she expects her income to go up pretty steadily.
A classic case. She knows her insurance needs will grow as her income does.
Yeah. So with the PUA rider, she could decide to buy, say, an extra $10,000 of coverage every single year for 20 years.
And she can do it without ever having to prove she's still healthy. It aligns her coverage with her career path automatically.
Okay, but the insurance company can't just leave this wide open. What are the limits? Why not just buy a tiny policy and then pour money into the PUA later when you're sick?
That's the catch. They have to manage their risk. So they set minimums just to make it worth the paperwork, but more importantly, they set strict maximums.
To prevent exactly what I just said.
Precisely. They stop people from waiting until they get a bad diagnosis and then trying to dump a huge amount of cash in for guaranteed coverage.
And for Valerie, it's a use it or lose it deal each year, right?
Correct. If she skips a year, she can't just buy double the next year. That option for that year is gone. It forces a certain discipline, which is kind of the point.
Okay, so if PUA is about building permanent value, our next rider, the term insurance rider, is all about flexibility and cost savings for temporary needs.
Exactly. This rider adds an extra death benefit, but only for a limited time, maybe 10, 20, or 30 years.
And what's the strategic advantage here? Why not just go out and buy a separate term policy?
Well, convenience is one thing. One policy, one bill. But the real win is the cost.
How so?
Every policy has a fixed annual fee. It can be $50, even $100. By bundling the term coverage as a rider, you only pay that fee once. Over 20 years, that really adds up.
And the real planning magic happens when you add a term rider to a permanent policy.
Oh, absolutely. This is where you can get really precise. It lets you cover short-term needs, like a mortgage, at a much, much cheaper term rate instead of bloating your permanent policy.
Let's talk about Zoltan, the business owner. He needs $500,000 of permanent coverage for a future tax bill when he dies.
A very common need for business owners. It's an indefinite liability.
But he also has a $200,000 mortgage that he knows will be paid off in exactly 10 years.
Right. So if he just bought a $700,000 whole life policy, he'd be overpaying. He'd be paying permanent rates for a temporary problem.
So the smart play.
The smart play is a $500,000 whole life policy plus a 10-year, $200,000 term rider. He gets the permanent coverage he needs and covers the mortgage for cheap. After 10 years, the rider just falls away.
It's perfectly tailored. But what happens if his main policy ends for some reason? Does he just lose that term coverage?
This is where you need to look for a critical feature, the conversion option.
Yep.
A good term rider will let you convert that temporary coverage into its own standalone permanent policy.
And I'm guessing the key part is you can do it without a medical exam.
Without providing any proof of insurability. That's the whole point.
So it's another health hedge. But what's the catch? If his health is terrible at that point, the new policy must be incredibly expensive.
It is. That's the trade-off. The premium for that new permanent policy will be based on his age at the time he converts. So if he's 65, it's going to be pricey.
But he's guaranteed to get it.
He is guaranteed access. And paying a high premium is infinitely better than having no option for coverage at all. It takes health out of the equation.
That idea of guaranteeing future coverage, it leads us right into family coverage riders.
Yes, and this is maybe one of the best planning tools for families out there. It's a way to simplify everything.
How does it work?
It's usually sold in units. So one unit might give you, say, $5,000 of coverage on your spouse and $1,000 on each child.
Okay, let's talk about the spouse first. That part is underwritten separately, right? Based on their age and health.
Correct. The spouse has to qualify, and their coverage usually ends around age 65. But the real strategic power here is with the kids.
What happens when you have more children? Does the price go up?
And that is the key. No. Once the rider is in place, the premium is fixed. Every child you have, biological, adopted, born later, is automatically covered from 15 days old until they're 21 or 25.
And the premium doesn't change at all.
Not 1 cent. Whether you have 1 child or 5, the cost is the same.
That's a huge advantage.
Yeah.
Let's go back to Valerie. She adds a family rider for her husband Robert and her twins, Rebecca and Charlotte. Now, say they have another baby.
That new baby boy is automatically covered for the same amount as his sisters as soon as he's 15 days old. No new application, no change in cost.
But the real aha moment, the thing financial planners always point to, isn't the death benefit itself. It's the conversion right.
This is the planning loophole. It's huge. When that term coverage on the child ends, at age 25, let's say, they have the right to convert it into their own permanent life insurance policy.
And let me guess.
Without providing any proof of insurability.
And some of these riders even let them convert for more than the original amount.
Yes, sometimes up to 5 times the rider amount. It's incredible leverage.
So let's look at Rebecca, one of the twins. Say she was born with a congenital heart defect.
If she tried to get insurance on her own at age 24, she'd be declined or face astronomical premiums.
But because of that simple rider her mom bought years ago.
She has the guaranteed right to convert her $20,000 coverage into a $100,000 whole life policy. Her heart condition is completely irrelevant. That small rider just secured her entire financial future.
Okay, we have 2 last protections to cover in our deep dive. The accidental death, or AD rider, and the guaranteed insurability benefit, the G rider.
Let's start with AD. People might know it as double indemnity.
Right, because it often doubles the payout.
Exactly. It pays an extra lump sum if the insured dies only because of an accident. And the definition here is very strict. It has to be from an unexpected violent event, and death has to happen within a certain time frame, like 90 days.
I can imagine the insurance companies are very careful about this. They want to make sure it wasn't a hidden health problem.
That's where all the exclusions come in. The usual suspects are there: suicide, war, committing a crime. But the really tricky part is separating an accident from a health event.
What do you mean?
So if someone has a massive heart attack while driving and dies instantly, then crashes. The death was from the heart attack. The rider won't pay. It wasn't an accident.
Okay, let's use the Janet example. She has a $250,000 policy with the AD rider. She has a mild heart attack, which causes her to crash, and she dies from the injuries from the crash.
In that case, her beneficiary got the full $500,000.
Why?
because the investigation showed that the crash injuries were the direct cause of death. The heart attack started it, but the trauma is what actually killed her. It's a very, very fine line.
And we should also note these AD riders have age limits. They don't last forever.
Right. You often have to apply before 55, and the coverage might end at 60 or 65.
Okay, that brings us to the last piece of the puzzle, the JIB rider, the guaranteed insurability benefit.
And this is really the ultimate safety net for your future self.
So what does it do exactly?
It gives you the guaranteed right to buy more coverage at specific points in the future, and you can do it without any medical questions, without proving you're still insurable.
But there has to be a cost. They can't just be giving away free insurance.
There is two things. First, you pay a small premium for the rider itself. Second, when you use the option to buy more insurance, you pay the rates for your new age.
So if you bought the policy at 25, but used the JIB at 40, you're paying the premium for a 40-year-old.
Exactly. The insurer takes on the health risk, but you take on the age risk. It's a fair trade.
Let's take Doug. He's 25, not a lot of cash, but he knows he's going to get married, buy a house, have kids.
He's the perfect candidate. He buys a policy now and adds the JIB. He's locking in his perfect health today for the future. Even if he develops diabetes in 10 years, he can still buy that extra coverage when his first child is born.
And what are the triggers? When can he buy it?
The contract defines them. It's usually on policy anniversaries or for major life events, getting married, having a baby, getting a mortgage.
But I'm guessing it's not unlimited.
Definitely not. There's a cap on how much you can add in total, and the option usually expires by age 50 or so. You have to be proactive to use it well.
So after all that, what's the big takeaway for you, the learner? I mean, it seems the base policy is really just the starting line.
It really is. The riders are the levers you pull to customize it, whether it's using a PUA to build savings faster or a term rider to cover a debt cheaply.
You now understand that this is about more than just picking a number. It's about blending different types of coverage and, more importantly, securing guarantees for your future.
Right. These riders let you handle today's needs while protecting you from what might happen tomorrow, like a new baby or, a change in your health.
And if there's one single lesson here, it has to be the power of that guaranteed insurability. We saw it with Rebecca. That simple family rider gave her a future she otherwise couldn't have had.
Which brings up a final thought for you to consider. Looking at your own planning, how much future protection are you giving up today? How much is that guaranteed right to buy coverage later worth?
Especially when you may need it most.
Exactly. Sometimes securing the right to buy the insurance is even more valuable than the insurance you own today.